Assalamualaikum warahmatullahi wabarakatuh. Today we want to present about government, fiscal, monetary dan direct policy. Before we start, I want to introduce my group member. First, me, Nur Azza Syahidah binti Usri, matric number 02 DAT20F2003. Second, Alia Masara binti Muhammad Safri, 02 DAT 20F2056. Third, Fadrin Nur Kristina binti Muhammad Fadil, matric number 02 DAT 2036, and Arifah Hanis binti Azwan, 02 DAT 20F20Y8. Okay, first we go to government policy. Okay, government policy, also known as a microeconomic policy. The function is to achieve government objective or economic goals. Microeconomic policy involves the use of fiscal, monetary and direct policies. Fiscal policy involves change government spending, tax and transfer payments. Monetary policy involves the use of charge in the money supply to affect the level of economic activity. Second, fiscal policy. Fiscal policy involves the change of tax rates and government expenditure or both in order to achieve the government economic and social objective. Fiscal policy carried out by the legislative and or the executive branch of the government. The two main instruments of the fiscal policy are government expenditure and tax. The purpose of the fiscal policy is to stabilize the economy. Objective of fiscal policy. First, securing efficient allocation of economic resources. Second, attaining and maintaining full employment. Third, accelerating the rate of economic growth. Last, controlling the equitable distribution of economic and wealth. Next, we go to tool of the fiscal policy. The fiscal policy consists to main tool, namely government expenditure and tax. Okay, let me explain. When an economy is in recession and deflation or unemployment, the government can increase its output by increase its expenditure or reduce tax or both. This type of fiscal policy is known as expansionary fiscal policy. Conversely, when economy is booming and the general price inflation has a tendency to increase, the government can implement a contractionary fiscal policy where government expenditure is decreased or the tax revenue is increased or both.
Okay, this is the types of fiscal policy. Fiscal policy can be divided into two types. First, discretionary fiscal policy, and second, non-discretionary fiscal policy. Discretionary fiscal policy can be divided into two. It is contractionary fiscal policy and expansionary fiscal policy. First, we look at discretionary fiscal policy. Discretionary fiscal policy, it is the change in tax and government expenditures to influence real output, manpower, inflation, and economic growth. And now we look at contractionary fiscal policy. Contractionary fiscal policy is also known as the surplus budget policy, which is defined as a decrease in government expenditures or increase in taxes that cause the government budget deficit to decrease or its budget surplus to increase. These measures slow down growth. The contractionary fiscal policy is adopted to overcome inflationary problems and create a budget surplus in order to reduce aggregate spending. The instruments in contractionary fiscal policy are the increasing of the taxes and the reduction of government spending. And now we look at the graph of combating inflation using contractionary fiscal policy. As a real GDP rise above its natural level, price also rise, prompting an increasing in wages and price of other resources. This causes the SAS curve to shift from SAS1 to SAS2. The end result is inflation of the price level from P1 to P3 with no change in real GDP. So the government can head off this inflation by engaging in a contractionary fiscal policy designed to reduce aggregate demand sufficiently to prevent the AD1 curve from shifting up to AD2. The government needs to decrease expenditures or increase taxes by small amount because of the multiplier effect that such action will have. Next, we move to expansionary fiscal policy. This policy is implemented by government to get the economy out of a slump by reducing taxes and increasing government expenditures. This measure will increase the disposable income, which will in turn lead to an increase in consumption. Fiscal policy is adopted to overcome unemployment or recession problems. The economy suffers from rising unemployment, falling income, and shrinking economic activity. The government increased public spending by undertaking public work programs and reduced taxes to increase the amount of disposable income of individual and business firms. This is combating a recession using expansionary fiscal policy. We assume that the economy is initially in a recession. The equilibrium level of real GDP, Y1, line below the natural level Y2, implying that there is less than full employment of the economy resources. Consequently, the recessionary climate may persist for a long time. According to the Keynesian, the way out of this difficulty is to run a budget deficit by increasing a government expenditures in excess of current tax receipt. The increase in government expenditures should be sufficient to cause the aggregate demand curve to shift to the right from AD1 to AD2, restoring the economy to the natural level of real GDP. Hence, the government needs to increase its expenditure by a small amount to cause aggregate demand to increase by the amount necessary to achieve the natural level of real GDP.
Okay, now I continue with non-discriminatory fiscal policy. Thus, non-discriminatory fiscal policy has an automatic effect on the view in stabilizing economy and is based on a taxation structure to economic activity. Basically, all type of tax will generate a high income for the government when GDP is high, especially progressive through for personal income tax, where high salary individuals are taxed at the higher rates. Okay, now when I explain, when GDP increase, corporate tax, sales tax, and excess tax, and the other type of tax also have tendency to increase. The higher tax will have a direct influence in reducing aggregate demand and slowing the rate of economic growth. On the other hand, when economic activity decreases and GDP decline, tax will decline on its own. Last, this will increase possible income after tax deduction, increase aggregate demand for goods and decrease the effect of economic recession. Okay, now I'm sure the graph of government expenditure and tax acting as a direct stabilizer. Point E is at the equilibrium budget, which means that government income is equal to government expenditure, which at generate national income level Y. When national income increase, total tax will increase according to the tax curve T, assuming the government expenditure G is not related to income. To the right of the point E, it can be seen that even though tax increase, government expenditure remains uninfluenced. This means that is a booming economy, tax collection is higher than government expenditure and the government is in a state of surplus budget. For example, at level 1, the surplus value is CD. During an economic recession, to the left of point E, tax collection decline because of income reduction.
The second is monetary policy. The monetary policy, or known as financial policy, refers to a policy which employs the central bank's control of the supply for achieving the objective of general economic policy. A monetary policy may aim to achieve the optimum level of employment and output price stability, balance of payments equilibrium, or other goals of the government's economy. The third, the central bank influence the cost of credit primarily by affecting the cash reserve of commercial banks in the economy. Types of monetary policy. First, expansionary, and the second, contractionary. Expansionary is increasing money supply to reduce unemployment, and the contractionary is reducing money supply to control inflation. Instrument of monetary policy. The tools of quantitative monetary policy. First, need for statutory reserve. Commercial merchant banks and financial companies are required to have a statutory reserve in the form of cash at central bank. This reserve is measured as percentage of basic deposit. It does not produce any returns and cannot be used to give loans. The change of statutory reserve rate is intended to influence the ability of financial institutions to give loans. Reserve requirements are used by the central bank to influence the ability of commercial banks to credit card. Inflation. Raising the reserve requirements increase the amount of required reserve the bank must keep. This will reduce the ability of banks or other financial intermediary to provide loans, and this has the effect of decreasing the money supply in the economy. Employment. Decreasing the reserve requirement decrease the amount of required reserve to bank must keep. This stimulates the ability of commercial banks to loan more money, this increasing the money supply in the economy. Second is minimum liquidity requirement. Commercial bank also have to keep liquidated asset issued by Bank Negara Malaysia (BNM), such as treasury bills and government securities. The more required liquidated asset that are held, the lesser the credit that can be created. The required minimum liquidated assets are fixed by Bank Negara Malaysia and are used as a monetary policy to control the Malaysia economic stability. Inflation, central bank will increase minimum liquidity requirement, and unemployment, central bank will decrease minimum liquidity requirement. Third is open market operation. This is a tool used by central bank to influence the money supply, which involves the buying and selling of government securities in the financial market. This activity will influence the position of financial institutions, reserve, and consequently their ability to give loans. Inflation, central bank sells government securities such as treasury bills to commercial bank, to the public, or to financial institution to draw money back from the financial institution. The money supply will be reduced in the market. As a result, the cash reserve of the commercial bank and their ability to create credit is reduced. Unemployment, when the central bank buys government securities from the commercial banks and individuals, this will inject money into the economy. Payment made will increase cash reserve of commercial banks, and these commercial banks can create more credit. Fourth, discount operation. Central bank is the final source of loan to other banks. When the central bank gives loans to bank, the interest rate known as discount rate is imposed. This rate is determined by the central bank based on the current situation. Inflation, a high discount rate will be imposed to reduce the loans to banking sector. Unemployment, a low discount rate will be imposed to encourage loans from commercial banks. Fifth, interest rate. Interest rate can be used to influence the cost of borrowing for consumption. Inflation, when money supply decrease, high interest rate might be seen as a requirement for controlling consumer spending. This will cause the savings to increase but discourage investment and consumption. And unemployment, when money supply increase, a lower interest rate means that it is cheaper to borrow money. This makes it easier for families to borrow money for a house or for business. This will decrease savings but encourage spending, which stimulates firms to increase production, is increasing GDP and lowering unemployment. And the last is funding. It is a process where government sells long-date debt, national savings security, rather than short-date debt, treasury bills. Inflation, it is the practice of managing the government debt by replacing short-term securities with longer term in order to influence the money supply.
Next, the tools of qualitative monetary policy. First, selective credit controls. Regulate the extension of credit for particular purpose. Tightening selective credit controls will limit certain types of spending, and realization will increase spending. Control on credit mortgage. Inflation. The central bank will prevent people from buying assets in mortgage such as housing. Unemployment. The central bank will encourage people to buy assets in mortgage such as housing. Control on credit installment. Inflation. Credit bank will prevent people from buying cars on credit installment by increasing the minimum down payment, reducing the amount of credit loans, and shortening the repayment period of installment credit. Unemployment. Central bank will persuade commercial banks to increase lending on certain economic sectors that can accelerate economic growth. Second, moral persuasion, where the bank organizes a direct meeting with commercial bank to request some action from them.
It involves the central bank advising financial institutions regarding measures that shall be taken. It can be conveyed through a speech, a press conference, or is informed directly by the central bank. To date, moral persuasion has been effective because financial institutions in this country frequently adhere to government policies. Inflation. Central bank will persuade commercial banks to reduce loans for speculative purpose. Unemployment. Central bank will persuade commercial banks to increase lending on certain economic sectors that can accelerate economic growth. Lastly, direct control policy. A control that directly imposes upon the manufacturing, pricing, and distribution of specific goods in contrast with an indirect or general control, such as a credit and fiscal policy that affects the economy in its entirety and specific goods only indirectly. There are three tools of direct control policy. First, training and technical education. More training and education should be provided for individuals who have difficulty securing a job. When individuals upgrade their skill and increase their knowledge, they will be able to find a job easily. Second, development of new land. Developing new land can create more job opportunities, especially for people from rural areas. The development of new land is through government agencies such as FELDA, RISDA, and FECRA. This can reduce unemployment and rural-urban migration. And last, job creation in various sectors of an economy. More job opportunities can be created if there is diversification in an economy. If all sectors in economy such as transportation, finance, insurance, service, tourism, manufacturing, construction, and other expand, it will create more jobs and thus reduce unemployment. That's all from us. Thank you.